As you start getting into your business finances, you're going to come across terms that you may not understand, or you think you do, and you're not really clear on what those definitions actually are. Well, this is kind of the equivalent of getting behind the wheel of a car and driving on the road without knowing what the rules of the road actually are. And so we want to make sure we understand terms like revenue and profit and assets or liabilities and these terms, because if we misunderstand what they actually mean, we potentially could make decisions that are not going to end well for our business. So in today's video, we're going to go over the 25 terms that I think every business owner should know in order to be able to safely navigate growing and scaling their business. My name is James Masotti. I am the owner of Our Team Accounting, and on this channel, I am passionate about helping entrepreneurs achieve their personal and professional goals through intentional financial planning. As we're getting ready to start, if there are specific terms that you are confused about or you would like to know more information about, go ahead and drop those in the comments down below. And if they aren't one of the terms that we cover in this video, we'll go ahead and make sure to answer those in the comments. Let's go ahead and dive right in. All right, our first term that we're going to go over is revenue. And another term for revenue is also sales. You might also sometimes hear the term income being used interchangeably here, but that's actually a term that can mean something different that we're going to go over a little bit later on. And what ultimately this revenue or sales number means is the amount of money that is coming into your business as a direct result of selling your products or services to your customers or clients. The next term that we want to make sure that we understand is what expenses are. And there's ultimately two different kinds of expenses. We have what would be considered direct expenses, and these are all the things that go directly into delivering your product or service, whether you're making something physical or you are selling some sort of a service. These are the direct costs associated with providing that to your clients. We then have indirect costs or expenses. Sometimes you might hear these referred to as overhead. And these are the types of expenses that your business will have regardless of the quantity of services that you provide. So they're called fixed expenses because the most common example of something like this would be like a rent or a mortgage. Regardless of how much product you sell, it's not going to change how much that payment is every month. Whereas if you are delivering a product or a service, that direct costs, such as labor, is going to potentially vary depending on how much you are providing to your customers. The next term that you're probably going to come across is profit. And profit is the end result of taking your revenue, subtracting your expenses, and it is the money that is quote unquote left over at the end. Now, these are paper profits, and we have to be careful with this term because for a lot of business owners, this is confusing because it doesn't actually line up with the amount of money that's sitting in their bank account. You could have more or you could have less. And that's why as a profit first professional, I prefer the profit first definition for profit, which is the actual amount of cash that is being retained by the owners of the business as a reward for them taking on the risky endeavor of actually being involved in the business. This definition of profit ties specifically to the amount of money that you have sitting in a bank account, as opposed to what is showing at the bottom of a financial statement, which for a number of reasons that we can get into in future videos may not actually match the amount of money that you have. The next term that we're going to go over is gross. And while this may sound like something that's going to be stinky and smelly, really it's just the starting point for where our numbers are. When we talk about something being in its gross form, we're talking about the purest form, the highest number, so to speak, without taking any sort of reductions, deductions, or subtracting anything out of it. So when we're talking about our gross income, we are talking about that total amount of money that we are bringing in before pulling anything out of it. This is by contrast with our next term, which is net. When we talk about net, we're talking about the result of a particular number after we reduce something out of the gross amount. And so when we talk about our net revenue or our net income, what we're actually talking about is taking that gross number and we're going to subtract certain adjustments out of it. And as a result of that, we will have the net that's left over. There's another term that's called net income, net operating income, and these are examples of other terms where certain things have been subtracted or reduced out of it to get to another line on our financial statements. So we've already touched on our next term a little bit, which is our gross revenue. And this, as I mentioned, is the total amount of revenue that we have brought into our particular business. So after we talk about our gross revenue, we're now going to be getting into our net revenue. And the net revenue is what we have left over after we subtract out discounts, allowances, and returns from our gross revenue. So if you're running some sort of a promotion or special and you're providing a discount, or if you have a physical product where you're getting returns, those all have to be adjusted off of the gross revenue in order to get you to a net revenue number. The next term that I want to talk about is cash. You may be looking at me going, "You're crazy. I understand what cash is." But this is where accounting terminology can get a little tricky. Cash has a very specific definition in accounting terms. And what it means is we're going to look at your financial statements when cash is actually transacting in and out of your business. This is called cash basis accounting. And it is in contrast to the other type of accounting that you can do, which is accrual. And that's our next word. In accrual accounting, we're going to line up when expenses actually are incurred versus when they are paid. And so the easiest example for me to kind of show the difference between these two things would be in an accrual-based accounting system. We'll take an expense that a lot of businesses have, like insurance. And a lot of insurance policies are paid on an annual basis. And so if we take a simple example and say we have an insurance policy that has a $1,200 monthly premium, in accrual accounting, we're going to take $100 of that premium and we're going to have that expense be assigned to each of the 12 months of the year, because that is how the consumption of that insurance is actually occurring. On a cash basis accounting, we're going to put the full $1,200 into the month where that expense is removed from the business. And this is one of those reasons why when we talk about those paper profits not always lining up with what's going on in your bank account. If you're running your financial statements on an accrual basis, which many businesses will do for the purposes of paying their taxes, it's not going to always line up with the amount of cash that's actually coming in and out of your business. But that doesn't mean that the cash basis is always going to tell you that either. And that's because there are certain items that will show up on your business financial statements that are what are called non-cash expenses. And we'll get into those a little bit later. If you've gotten to this point in the video and you're sitting there thinking, "Oh my gosh, James, you're talking way too fast. I cannot keep track of all of these definitions. I'm writing as fast as I can." Don't worry, we've got you covered. If you scan the QR code on your screen or you click the link in the description, you'll be able to download the PDF guide that we've put together that has all 25 of these terms and their definitions captured for you. All right, so our next term is assets. And these are things that your business owns that it is expected are going to bring good, prosperous economic returns to your business in the near future. These are going to be things like cash. It could be things like real estate. It could be your vehicles. It could be any equipment that you have for your business. It can also include what's known as your accounts receivable, which is money that people owe you, but they haven't actually paid you yet. And those are all assets for your business. Now, we're going to contrast that with our next term, which are liabilities. And these are things that you are going to owe to other people. And there's 3 different types of liabilities that can exist within inside of a business. The first is what are known as short-term or current liabilities. The second is what would be considered long-term liabilities. And the third are contingent liabilities. So short-term or current liabilities are things that you owe to people sometime in the next 12 months. That may not seem like current, but that is the definition that is used under GAAP or the generally accepted accounting principles. So these are going to be things like accounts payable or money that you owe to other people. It's going to be credit cards. It's going to be any short-term loans that have less than 12 months remaining on paying them off. It may include things like wages that you owe to your employees if you pay them over a period of time that doesn't line up with your financial statements. It can include paid time off. If you have employees who are accruing time off, but they haven't used it yet, then that is an accrued liability that you are going to eventually need to pay when they do eventually take that time off. So things that could also go in here is taxes that you've accrued. So these could be if you have like quarterly payroll taxes, or if you're making quarterly tax remittances to the IRS, you should be accruing those as you go before you pay them out. Another form of short-term liabilities would be what's considered unearned revenue. Unearned revenue oftentimes comes in the form of if you're taking deposits on work that you haven't actually started yet. This is money that's sitting in your bank account now, but you haven't actually earned it yet. And so it has to be actually registered as a liability on your balance sheet. Next, we're going to get into long-term liabilities, which is basically anything that is going to be being paid over a course that's greater than 1 year in length. The most common form of this is oftentimes mortgages and other loans that are on greater than 1 year time horizons. There are a few other exceptions as well, though. If you happen to have deferred tax payments, oftentimes these are things that municipalities or states may offer to you as part of doing business in a particular area. Some other ones that are less frequent but could come up is if you have any deferred lease obligations, such as security deposits that you're holding. Things that come up is like if you have pension liabilities in your organization, you would need to capture those also here on this long-term liabilities section. This next one is an area that doesn't apply to a lot of businesses, but when it does apply is something that you want to be aware of, which is the contingent liabilities. And these are liabilities that may happen, but aren't necessarily guaranteed. Probably the most common form of this that folks might have is if you are offering a warranty on your products, then you have incurred a liability because some portion of your products or your services are going to trigger that liability that you're ultimately going to need to be paying out. Other things here could include pending lawsuits if you are expecting to have a liability that you may need to pay out if the lawsuit does not go in your favor. Some other potential things would be environmental concerns. If you are in a business that involves, chemicals or waste product, or you're sitting on water reserves or anything along those lines where there may be environmental impacts to your business being carried out, you may need to be accruing a liability to help remedy or resolve any of those. And another one that a lot of businesses that are in the physical product space will have is that for obsolete inventory. So at some point, whether your product is perishable or not, you're potentially going to have obsolete inventory that you're eventually going to realize, hey, I can't actually sell this anymore, and I need to be prepared to write it off. Now that we've talked about liabilities, we're going to jump into our next two terms, which are ones that people confuse a lot. And this is one that's really important. And we're going to go over them together because, to be honest with you, I even get this one confused sometimes. And I almost always need to look it up before I tell somebody what the definition of these things are, because they're easy to get confused. And those two terms are the difference between markup and margin. And the reason that they're so easy to get confused is they're almost identical in how they're calculated, but for one exception. Let's say that you have a product that costs you $100 to make, and you're going to sell it for $150. Well, this means that the markup, the amount that you've increased your cost by, is $50. And that $50 then represents a 50% markup on your product. Now let's look at it the other way around, which is how we're going to calculate our margin. We have a product that we sell for $150, and because our cost on that product is $100, then we are going to make $50. And because $50 is 30% of $150, our selling price, our margin on that item is 30%. And this is why it can be very confusing, because we've got the same set of three numbers, $100 on our cost, $50 between the difference of our cost and our selling price of $150, that people often interchange these terms or get them confused. And it is important to understand that a 50% markup on your product is the equivalent of a 30% margin on your selling price. Our next term that we're going to go over is depreciation. Depreciation is one of those things that people understand, but also don't. And the reason I bring that up is what this is it's technically a IRS tax requirement that when you purchase assets that are of greater dollar value, that you can't take those as a large expense all in the year that you've purchased it. It is interpreted that those particular assets are going to have a life expectancy that goes many, many, many years into the future. And as a result of that, you are only going to be allowed from a tax perspective to take the value of that item in certain specific buckets. The one that's probably most prevalent in most people's lives is those that own their own home. You can't actually take a write-off for the purchase of that home all entirely in the year that you do it. the IRS only allows you to depreciate that property over 27 and a half years. And this is important to understand because depreciation doesn't necessarily line up with the actual lifespan of a particular item. If you do have an asset that you've been depreciating over a period of time and you're considering selling it, I would strongly encourage you to have a conversation with your tax professional on understanding what the potential tax implications are of selling that product. And the reason for that is a lot of times the IRS will make you do what's called depreciation recapture. And this is a process whereby if you sell it for more than what you've depreciated, basically the IRS is going to say you owe us taxes on that amount of money. And so while you've avoided or you've been able to reduce your taxable liability for the years that you were taking that depreciation expense, you're now actually going to have to pay that money out when you've now sold and you have money coming back into your business from the sale of that asset. This is one of those key reasons why, if you have these assets that are being depreciated, that when we look at our income statement, our profit and loss, that the profit that shows at the bottom of that isn't always going to line up with what's in our bank, because this depreciation expense is what's called a non-cash expense. You'll see it on there and it's going to reduce the total amount that you have to pay taxes against, but it's not actually money coming out of your bank account. Whereas when you sell that item and you have that depreciation recapture, you may have money coming into your bank account that's not necessarily being reflected on your income statement. There's another term that goes hand in hand with depreciation, and that term is amortization. And amortization and depreciation are two sides of the same coin. But depreciation is used for physical assets, where amortization is used for non-physical things. So if your business has trademarks or patents, or if you were to, for example, purchase software for your business, expensive software like a large CRM or ERP system or something to that extent, these would fall under buckets where you would amortize certain expense. If there is goodwill associated with your business, that's often the case if you acquired your business, then there is a certain amount of that you're going to be able to amortize over a period of time. And so both of these, both depreciation and amortization, are terms that represent non-cash implications for the business, but have tax purposes that are going to matter to your tax preparer and to the IRS. That drive how you're going to ultimately get to the amount that you have to pay in taxes. Another item that you're going to find on your balance sheet is the owner's equity. And owner's equity is represented on the balance sheet as the difference between the assets that you own and if you subtract the liabilities from that. This is basically the amount of money that you have either put into the business as an owner, or the amount of money that the business owes you as a result of the resources that the business has accumulated and has not yet been distributed out to the owners. A lot of times this is what's referred to as the value of a business, but I don't really love that term, because when you actually get into the process of business valuations, they're not actually tied to this book value or the owner's equity. Business valuations are a complex series of calculations that has to do with cash flow, that has to do with the market value, or the amount, the multiple that markets are willing to pay for the revenue that your business generates. If you have things like inventory and vehicles or other capital assets, all of that can drive the book value of your business. Working capital is our next term, and this is one that has kind of two varying definitions. The first is a little more technical in nature, and it's the representation of taking your current assets, which, if you recall, are those that have 12 months or less to be converted into cash, and you subtract your current liabilities, which are anything you have to pay out in the next 12 months, is considered to be your working capital. So this is things like cash and your inventory and things along those lines. Now, in a more colloquial sense, we often think more about working capital as what we can get our hands on and pay things in order to keep the lights on in our business in a much shorter, more like 30-day kind of timeline. And so it's important to understand kind of this technical definition, which is using your current assets minus your current liabilities, because that is the technical term that people may use and may throw around. But if you're just having kind of more of a general conversation with folks, you may hear somebody throw out like, oh yeah, I've got 60 days of working capital. Well, what does that actually mean to them? Oftentimes they're talking about the cash in the bank they have, or again, if it's something where they're selling inventory and things along those lines. So just when you're having those conversations, use some context, or if you're not sure, ask for clarification, especially if you're talking with somebody like a banker or an insurance person, to really understand what they're looking for when they ask you about your working capital. Our next term is the income statement, which has two other names that it goes by as well. If you've ever heard the term profit and loss, or its shortened form, the P&L, those are all the same things. So if you hear somebody say income statement, P&L, profit and loss, no, all three of those refer to the exact same document. And that document is one of the three critical financial statements that your business will operate on. That shows the amount of revenue that your business is bringing in, the amount of expenses that you ultimately have in your business, and it will show you the amount of profit that you have generated at the end of the day as well. One thing that's important to note about the income statement is that it can be shown on either a cash or an accrual basis. And we talked about the differences that can have depending on how your business structures not only its expenses, but also its revenues. The balance sheet is the next term, and that's the second of the three most critical financial statements that you're going to have in your business. It shows you the total amount of the assets that your business owns, the total amount of liabilities that you owe to other people, and the amount of owner's equity that you have generated. It's called a balance sheet because the conventional formula is that of assets equals liabilities plus owner's equity, or I like to think of it more as owner's equity equals my assets minus my liabilities. Just understand, for some reason, that's not the technical formula definition. But again, this is what always going to balance out. All three of those things will need to be in the appropriate amounts, or you'll have a problem. Your balance sheet is going to often be run on an accrual basis rather than a cash basis. And the reason for that is things like your accounts receivable and accounts payable are being accrued in nature because you're waiting for that cash to come into your business. So if you were to run your balance sheet on a cash basis of accounting, those are going to drop off and you're not going to be seeing the full picture of really the health of where your business is at. So running an accrual basis is going to be important so that you make sure that your accounts receivable and your accounts payable really do show up and you get that full picture of the health of your business based on that particular snapshot in time. Our next term is cash flow statement, which is the third of the main three business financial statements that you're going to have. And just kind of like it sounds, this shows us all of the money going into and out of our business, regardless of where that money actually comes from. Because we're very specifically talking about your cash, those very liquid assets, we always are going to run this in a cash basis. So as compared to our income statement and our balance sheet, which you may want to look at from an accrual basis to really see how things line up and where all of your expenses are coming together with your revenue, you're also going to really want to take a look at how the cash is flowing in and out of your business to make sure that you don't run into a cash crunch. And the cash flow statement is what's going to help you do that type of analysis. Next, you probably are going to hear the term general ledger or the GL. And really that is just, if you pictured like a gigantic running list of every transaction that ever happens in your business, that is your general ledger. And it gets its name from way back in the day when there actually used to be manual ledgers where everything was getting hand recorded over time. Now with online tools, you can go in and run a general ledger report, but very rarely are you actually going to be seeing your general ledger. The next term that we're going to talk about is going to be debits. And debits are basically just things that are going to be recorded on the left side of our transactions. If we were to go and run that general ledger report or take a look at one of those old school general ledgers, debits are going to increase our assets and our expenses, and they are going to decrease our liabilities, our equity, and our revenue. The opposite of our debits is going to be our credits. And so our credits are always going to be recorded on the right side of our general ledger, and they are going to do the exact opposite of the debits. So they will reduce our assets and our expenses, and they are going to increase our equity, our liabilities, and our revenue. And yes, let's be clear, I had to practice that a whole lot of times because it trips me up every time I even have to say those things. So now that we've talked about our general ledger, we're going to talk about the chart of accounts. And you may hear a term called a GL account. And that is referring to the specific items that when you look at your financial statements, you're going to see like these categories and these descriptions for each type of expense or each type of revenue or each asset or each liability is going to have its own entry in all of your financial documents. These GL accounts are really strongly recommended to be numbered, and there is a traditional numbering sequence that you're going to want to go ahead and really take advantage of in order to kind of adhere to industry norms and standards. So I'm going to go ahead and put up on screen right now what that normal number range is. But basically, we're going to start off in our thousands range, and we're going to go through and start off with our assets in that 1,000 range. Then we're going to have our liabilities be a part of the 2,000 range. We're going to have our equity be in the 3,000 range. Then our revenues are going to be in the 4,000 range. Our cost of goods sold are going to be in the 5,000 range. Payroll is going to be in the 6,000 range. Our expenses are going to be the 7,000 range. 8,000 is going to be our other income category. And generally in the like 8,100 or 9,000 range is where you're going to put your other expenses. Now, what's important to understand is the reason we use these 4-digit long chart of account numbers is so that you have space to be able to expand and to grow. So when you're creating your number system, you want to be able to give yourself a little bit of space so that you can group things together. It's also important to understand that as your business grows and gets more complex, you may also need to expand from these 4-digit number sequences to ones that are much larger. Oftentimes in large companies, they can have GL accounts that go into 6, 7, 8, 9 digits long because they try to put meaning behind what all the different number sequences and ranges mean, so that across very large, complex, business structures, they have an ability to pull things out and do a compare and contrast. Now that we've gone over all of these key accounting terms and definitions, we're going to start diving deeper into our 3 main accounting documents. So click this video on screen here, and I will see you there.